And here we are again at 10 p.m. on a Wednesday, January 11th, 2023. Bitvago is a Dutch cryptocurrency exchange. They are also a creditor of Digital Currency Group. Well, Bitvago rejected DCG's offer to repay a portion of their debt. DCG had suggested repaying about 70% of the total amount, but Bitvago didn't find the terms of the proposal acceptable. They said that the two sides are still in negotiation regarding how much debt DCG will repay. Now, DCG has only offered to repay a portion of the debt and only under terms that are acceptable to Bitvago. However, Bitvago has said that as a creditor, it doesn't find this offer acceptable because DCG has enough resources to repay the full amount of debt. They said that the situation with Digital Currency Group will not affect their customers, platform, or service. They guarantee that the outstanding amount is secure and that they've taken on the risk themselves. Bitvago stated that they have enough resources to keep serving their customers without interruption, and that they expect DCG to refund any outstanding balances, even though they are currently experiencing financial difficulties. The exchange mentioned that it's pretty much in the same boat as the Winklevoss brothers exchange, Gemini. As we talked about last night, Cameron Winklevoss publicly accused Barry Silbert, the CEO of DCG, of fraud. Not only that, but Winklevoss called for Silbert to be replaced. Well, DCG and its subsidiary, Genesis Capital, owe Gemini about $900 million. Bitvago said that it agrees with Gemini that a positive solution can be found that would be satisfactory to all parties involved. Now, they are experiencing financial difficulties due to the collapse of FTX in November. The situation has become worse for DCG after reports that the U.S. Department of Justice and the Securities and Exchange Commission are investigating the company. Silbert wrote a public letter to shareholders on January 10th to defend his actions and provide information about loans from Genesis and relationships with companies such as Three Arrows Capital. Speaking of FTX, as we usually are these days, an LLC associated with Peter Thiel is listed as a shareholder in FTX. This came out in their filing for Chapter 11 bankruptcy. The filing also includes details on the shareholdings of those closely connected to former CEO Sam Bankman-Fried. A list filed on January 9th reveals the names and number of shares held by equity holders in various FTX subsidiaries. These include West Realm Shires Incorporated, FTX Trading Inc., Clifton Bay Investments, and others. The list also shows the shareholdings of well-known figures such as NFL quarterback Tom Brady, supermodel Gisele Bündchen, investor and TV personality Kevin O'Leary, and various venture capital and investment firms. The filing shows that Peter Thiel's Revendell Trust, a family trust, and Thiel Capital were connected to an investment vehicle called 2001-015 Investments LLC. This LLC received 245,000 shares from West Realm Shires and 57,230 shares from FTX Trading Limited. Now, previously, it was unknown that he'd even invested in FTX. It was only revealed in November of 2022 that Thiel had invested in crypto lender BlockFi through Valor Ventures. Now, BlockFi, which had a $680 million deal with FTX US, filed for Chapter 11 bankruptcy protection following the collapse of the exchange. The list of equity holders is based on currently available information and will be updated as the proceedings continue. The Counsel for the Debtors and Debtors in Possession mentioned that investigation into the individuals and interests listed on the equity holders is ongoing. Some key players from FTX Ventures are not included on the list. This includes Amy Wu, who was the head of the Ventures arm, and Ramnek Arora, who is a partner in the Ventures arm, and also served as the head of product at FTX. Brett Harrison is also not on the list. He previously said that he will share information about FTX US at a later time. FTX raised $1.8 billion from over 90 investors since 2018. Many names in the publicly available document are still redacted, with the U.S. government and journalists pushing for a more complete listing of top creditors. The court documents provide some information about the inner circle of Bankman-Fried, showing the number of shares held by top executives in various subsidiaries. Speaking of BlockFi, creditors in the BlockFi bankruptcy proceedings want to keep their personal information secret because they're afraid of identity theft or hacking. A U.S. Department of Justice official, Andrew Vara, argued that, quote, disclosure is a basic premise of bankruptcy law, and he said it's necessary. This issue will be discussed at a hearing on January 17th. people are thinking back about how Celsius users had their info made public during their bankruptcy proceedings. FTX has recovered $5 billion in cash and liquid cryptocurrencies. However, they are still trying to rebuild the transaction history, and it's not clear how much money customers are missing. The recovered assets do not include those taken by the Bahamas Securities Commission. The attorney Andy Dietrich told the judge that the company plans to sell $4.6 billion worth of non-strategic investments. Reportedly, these investments may include subsidiaries. And that's because subsidiaries like LedgerX, Embed, FTX Japan, and FTX Europe are independent and have separate accounts. FTX Japan has plans to return customer funds. FTX also plans to end a sponsorship deal with the popular online game. FTX has total liabilities of $8.8 billion. At the time, it was reported that the exchange had very little cash and digital assets. That left a $8 billion gap in its balance sheet. In a hearing on January 11th, FTX received permission from the court to keep customers' names private for 3 months after customers raised concerns about identity theft. The U.S. Attorney's Office for the Southern District of New York has created a task force to locate and recover missing customer funds and handle investigations and prosecutions related to the collapse. U.S. lawmakers previously asked the court to appoint an independent examiner in the FTX bankruptcy case because of conflict of interest concerns, but it was rejected by the judge. So what happened there is these 4 U.S. senators, Cynthia Lummis, Elizabeth Warren, Tom Tillis, and John Hickenlooper, they criticized the law firm involved in the bankruptcy case of FTX. The senators wrote a letter to the judge asking for an independent examiner to investigate the company's activities before its collapse. They said that the current law firm, Sullivan & Cromwell, has a conflict of interest because it previously provided services to FTX. Further, one of its partners even served as company's general counsel. The senators wrote in a letter that FTX and other digital asset firms have caused significant harm by destroying the savings of many customers worldwide. They believe that it's important to appoint an independent examiner to investigate the company and its related entities, as well as to uncover the facts, assure that justice is served, and to inform future digital asset legislation. The senators also mentioned that the current law firm may be partially responsible for the damage caused and is not in a position to conduct a proper investigation. A spokesperson for the law firm said that the firm did not serve as the primary outside counsel for any FTX entity. They said that they had a limited and transactional relationship with FTX and its affiliates prior to the bankruptcy. Now, they claim that the firm meets the definition of disinterested as required by U.S. Bankruptcy Code. Well, the judge isn't having it. Judge John Dorsey said that the letter was inappropriate and that his court won't be moved by it. Dorsey said that the letter is not appropriate because it does not give all parties the chance to be represented. He also stated that he will only make decisions based on the evidence presented in open court and the arguments of the parties. The trial for Bankman-Fried is expected to start in October. U.S. authorities targeted assets previously controlled by FTX and its executives. The U.S. DOJ announced that they seized more than 55 million shares of Robinhood and over $20 million of U.S. currency as part of their case against SBF. Okay, so let's change gears here, because a group called Fight for the Future has posted an open letter on their website. This letter urges the new members of the U.S. Congress to protect privacy. The letter has been signed by many companies and organizations, and it's an appeal for digital privacy, balanced power, and human rights. The authors of this letter believe that U.S. software developers are facing limitations on their creativity due to poor legislation and regulations. They also mention that the First Amendment of the United States Constitution protects code as speech. They say this is why many privacy-protective technologies are created in the United States. This letter encourages new legislators to create a digital future that is robust, by mentioning several technologies and communications protocols by name. The authors also encourage the lawmakers to protect privacy rights, support end-to-end encryption, and safeguard personal data. They also called for the need to restore the balance of power. The authors said that they want online spaces that are not controlled by a single person. They say this poses a lot of risk to user privacy. The director at Fight for the Future, Leah Holland, stated that the goal of the letter is to raise awareness of the previous Congress's neglect of privacy as a human right. She says that it's time for legislators to stop punishing open source and decentralized software developers who are providing privacy protection tools to everyday users, as well as vulnerable communities like journalists, activists, survivors of abuse, and minorities. Now, the last I heard, it had 36 signatories on it, including big players from the industry, like the Blockchain Association, DeFi Education Fund, Ledger, Nillion Network, Protocol Labs, and Proton. The letter is still accepting new signatures. Voyager Digital has been given initial approval by a bankruptcy judge to sell its assets to Binance US for $1.02 billion. This sale still needs the approval of creditors and final court approval. The approval for the sale is happening while there is national security investigation into Binance US. Voyager is trying to hasten the review process. The sale has been approved by a judge to enter into an asset purchase agreement, but still requires creditor approval and another court hearing for finalization. The attorney for Voyager, Joshua Sussberg, stated during the court hearing that they have been responding to questions from the Committee on Foreign Investment in the United States, CFIUS. He will address any concerns that CFIUS has that could lead to the transaction being opposed. Sussberg said that they're working with Binance and their attorneys to address the investigation and to move forward with the process. The Committee on Foreign Investment in the United States is a group that examines foreign investments or acquisitions of U.S. companies for national security issues. If it finds that there are national security concerns related to the deal, CFIUS can prevent the deal, undo it, or ask for changes to the deal to address those concerns. CFIUS filed a court notice on December 30th that said some of the transactions Voyager is considering could be reviewed. This could lead to potential blocks or delays. Binance's global entity is being investigated by the U.S. Attorney's Office for alleged money laundering. However, CEO Chaopeng Zhao, or CZ, stated that Binance US is a separate and independent entity based in California. CZ is a Chinese-born Canadian citizen. CFIUS has the authority to review any transactions that might result in foreign control of a U.S. business or give a foreign person an equity interest. The Voyager Official Committee of Unsecured Creditors supports the current transaction, as it would result in higher recoveries for creditors than if Voyager liquidated its holdings alone. This scenario could still play out if CFIUS blocks the transaction. Objections to the acquisition proposal from the Alameda Research, the SEC, 4 U.S. states, and the U.S. trustee were previously addressed by the bankruptcy lender on January 8th. Voyager stated that the transaction is in the best interest of its creditors, and the objections did not have factual or legal support. Voyager announced on December 19th that it accepted a deal with Binance US to acquire its assets for $1.022 billion. After the $1.4 billion deal with FTX fell through. Crypto.com will remove Tether from their platform in Canada in the name of regulatory compliance. They announced the delisting on January 9th. Some speculate that the site's decision to delist USDT was due to a business deal with Circle to eliminate competition. Another user commented that Tether has a shady history and previously lied about being pegged 1-to-1 to the US dollar. For the record, I don't know that any of this is true. I do know that some users are concerned that delisting USDT in Canada will cause a problem, as it leaves them with fewer options for earning interest on their money. Now, many were dissatisfied with the decision, but some believe that regulations are necessary for the growth and mainstream adoption of cryptocurrencies, and that they're needed to attract large players to the industry. Crypto.com has not officially announced a decision yet. It's not yet clear if it's temporary or if it's a permanent change, as it will be effective until further notice. And finally tonight, Albright Capital has ended its lawsuit against Terraform Labs and Kwon. The lawsuit accused them of breaking the law by operating their algorithmic stablecoin as a Ponzi scheme. The dismissal was filed in the U.S. District Court on January 9th. Zuzu posted on Twitter about the dismissal of the lawsuit against the Luna Foundation and Luna investors. He had previously said that 3AC's bankruptcy was partly caused by UST's collapse. Terraform Labs and its founder Kwon face multiple lawsuits and an arrest warrant in South Korea. Now, they specifically allege that it was a Ponzi scheme sustained by Anchor's excessive yields. This lawsuit has now been dismissed by the plaintiff. It was dismissed without prejudice, which means that it can be filed again in the future if the plaintiff chooses to. And that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. We'll see you tomorrow night.